Welcome to Windfall Edutech Advanced Module. Chapter 2 Introduction to Derivatives. What are derivatives? Basic purpose of derivatives. Example, derivative contract. Evolution of derivative concept. Insight into forward contract. Default risk in forward contract. Insight into futures contract. Insight into options contract. Two types of options contracts. Derivative terminologies, demystified. Moneyness of an option. Participants in derivative market. Uses of derivatives. What are derivatives? The term derivatives is used to refer to financial instruments which derive their value from some underlying assets. The underlying assets could be equities, shares, debt, bonds, T-bills, and notes, currencies, and even indices of these various assets, such as the Nifty 50 index. Derivatives derive their names from their respective underlying asset. Thus, if a derivative's underlying asset is equity, it is called equity derivative and so on. Derivatives can be traded either on a regulated exchange, such as the NSE, or off the exchanges, that is directly between the different parties, which is called over-the-counter (OTC) trading. In India, only exchange-traded equity derivatives are permitted under the law. Basic purpose of derivatives. The basic purpose of derivatives is to transfer the price risk inherent in fluctuations of the asset prices from one party to another. They facilitate the allocation of risk to those who are willing to take it. In so doing, derivatives help mitigate the risk arising from the future uncertainty of prices. Example, derivative contract. On October 1, 2009, a rice farmer may wish to sell his harvest at a future date, say February 1, 2010, for a predetermined fixed price to eliminate the risk of change in prices by that date. Such a transaction is an example of a derivatives contract. The price of this derivative is driven by the spot price of rice, which is the underlying. Evolution of derivative concept. While trading in derivatives products has grown tremendously in recent times, the earliest evidence of these types of instruments can be traced back to ancient Greece. Even though derivatives have been in existence in some form or the other since ancient times, the advent of modern-day derivatives contracts is attributed to farmers' need to protect themselves against a decline in crop prices due to various economic and environmental factors. Derivatives contracts initially developed in commodities. The first futures contracts can be traced to the Yodoya rice market in Osaka, Japan around 1650. The farmers were afraid of rice prices falling in the future at the time of harvesting. To lock in a price, that is, to sell the rice at a predetermined fixed price in the future, the farmers entered into contracts with the buyers. These were evidently standardized contracts, much like today's futures contracts. In 1848, the Chicago Board of Trade (CBOT) was established to facilitate trading of forward contracts on various commodities. From then on, futures contracts on commodities have remained more or less in the same form, as we know them today. At present, the equity derivatives market is the most active derivatives market in India. Trading volumes in equity derivatives are, on an average, more than 3.5 times the trading volumes in the cash equity market. An insight into forward contracts. A forward is thus an agreement between two parties in which one party, the buyer, enters into an agreement with the other party, the seller, that he would buy from the seller an underlying asset on the expiry date at the forward PKL rice, to engage in a transaction at a later date with the price set in advance. This is different from a spot market contract, which involves immediate payment and immediate transfer of asset. Default risks in forward contracts. A drawback of forward contracts is that they are subject to default risk. Regardless of whether the contract is for physical or cash settlement, there exists a potential for one party to default, that is, not honor the contract. It could be either the buyer or the seller. This risk of making losses due to any of the two parties defaulting is known as counterparty risk. The main reason behind such risk is the absence of any mediator between the parties, who could have undertaken the task of ensuring that both the parties fulfill their obligations arising out of the contract. An insight into futures contracts. A futures contract is an agreement between two parties in which the buyer agrees to buy an underlying asset from the seller, at a future date at a price that is agreed upon today. However, unlike a forward contract, a futures contract is not a private transaction but gets traded on a recognized stock exchange. In addition, a futures contract is standardized by the exchange. All the terms, other than the price, are set by the stock exchange, rather than by individual parties as in the case of a forward contract. However, both buyer and seller of the futures contracts are protected against the counterparty risk by an entity called the clearing corporation. The clearing corporation provides this guarantee to ensure that the buyer or the seller of a futures contract does not suffer as a result of the counterparty defaulting on its obligation. In case one of the parties defaults, the clearing corporation steps in to fulfill the obligation of this party, so that the other party does not suffer due to non-fulfillment of the contract. To be able to guarantee the fulfillment of the obligations under the contract, the clearing corporation holds an amount as a security from both the parties. This amount is called the margin money and can be in the form of cash or other financial assets. Since the futures contracts are traded on the stock exchanges, the parties have the flexibility of closing out the contract prior to the maturity by squaring off the transactions in the market. An insight into options contracts. Like forwards and futures, options are derivative instruments that provide the opportunity to buy or sell an underlying asset on a future date. An option is a derivative contract between a buyer and a seller, where one party, say first party, gives to the other, say second party, the right, but not the obligation, to buy from or sell to the first party the underlying asset on or before a specific day at an agreed-upon price. In return for granting the option, the party granting the option collects a payment from the other party. This payment collected is called the premium or price of the option. The right to buy or sell is held by the option buyer. Also called the option holder, the party granting the right is the option seller or option writer. Unlike forwards and futures contracts, options require a cash payment, called the premium, upfront from the option buyer to the option seller. This payment is called option premium or option price. Options can be traded either on the stock exchange or in over-the-counter (OTC) markets. Two types of options contracts. There are two types of option contracts. Call option, put option. Call option. A call option is an option granting the right to the buyer of the option to buy the underlying asset on a specific day at an agreed-upon price, but not the obligation to do so. It is the seller who grants this right to the buyer of the option. It may be noted that the person who has the right to buy the underlying asset is known as the buyer of the call option. The price at which the buyer has the right to buy the asset is agreed upon at the time of entering the contract. This price is known as the strike price of the contract, call option strike price in this case. Since the buyer of the call option has the right, but no obligation, to buy the underlying asset, he will exercise his right to buy the underlying asset if and only if the price of the underlying asset in the market is more than the strike price on or before the expiry date of the contract. The buyer of the call option does not have the obligation to buy if he does not want to. Put option. A put option is a contract granting the right to the buyer of the option to sell the underlying asset on or before a specific day at an agreed-upon price, but not the obligation to do so. It is the seller who grants this right to the buyer of the option. The person who has the right to sell the underlying asset is known as the buyer of the put option. The price at which the buyer has the right to sell the asset is agreed upon at the time of entering the contract. This price is known as the strike price of the contract. The buyer of the put option does not have the obligation to sell if he does not want to. Since the buyer of the put option has the right, but not the obligation, to sell the underlying asset, he will exercise his right to sell the underlying asset if and only if the price of the underlying asset in the market is less than the strike price on or before the expiry date of the contract. The buyer of the put option does not have the obligation to sell if he does not want to. Derivative terminologies demystified. Spot price, street. Spot price of an underlying asset is the price that is quoted for immediate delivery of the asset. At the NSE, the spot price of Reliance Limited. At any given time is the price at which Reliance Limited shares are being traded at that time in the cash market segment of the NSE. Spot price is also referred to as cash price sometimes. Forward price or futures price F. Forward price or futures price is the price that is agreed upon at the date of the contract for the delivery of an asset at a specific future date. These prices are dependent on the spot price, the prevailing interest rate and the expiry date of the contract, S. Strike price K, the price at which the buyer of an option can buy the stock in the case of a call option or sell the stock in the case of a put option on or before the expiry date of option contracts is called strike price. It is the price at which the stock will be bought or sold when the option is exercised. Strike price is used in the case of options only, it is not used for futures or forwards. Types of options. European options. These are options that can be exercised only on the expiration date. All options based on indices such as Nifty, Mini Nifty, Bank Nifty, CNXIT traded at the NSE are European options which can be exercised by the buyer of the option only on the final settlement date or the expiry date. American option. The SR are options that can be exercised on any day on or before the expiry date. All options on individual stocks like Reliance, SBI, and Infosys traded at the NSE are American options. They can be exercised by the buyer on any day on or before the final settlement date or the expiry date. Margins. In the spot market, the buyer of a stock has to pay the entire transaction amount for purchasing the stock to the seller. If Infosys is trading at 2,000 rupees a share and an investor wants to buy 100 Infosys shares, then he has to pay 2,000 rupees into 100 equals 2 lakh rupees to the seller. The settlement will take place on T+2 basis, that is, 2 days after the transaction date. Futures and option contracts are traded through exchanges and the counterparty risk is taken care of by the clearing corporation. In order to prevent any of the parties from defaulting on his trade commitment, the clearing corporation levies a margin on the buyer as well as seller of the futures and option contracts. This margin is a percentage, approximately 20%, of the total contract value. Thus, for the aforementioned example, if a person wants to buy 100 Infosys futures, then he will have to pay 20% of the contract value of 2 lakh rupees equals 40,000 rupees as a margin to the clearing corporation. This margin is applicable to both the buyer and the seller of a futures contract. Moneyness of an option. Moneyness of an option indicates whether an option is worth exercising or not, that is, if the option is exercised by the buyer of the option, whether he will receive money or not. Gins. Moneyness of an option at any given time depends on where the spot price of the underlying is at that point of time relative to the strike price. The premium paid is not taken into consideration while calculating moneyness of an option, since the premium once paid is a sunk cost and the profitability from exercising the option does not depend on the size of the premium. Therefore, the decision of the buyer of the option whether to exercise the option or not is not affected by the size of the premium. The following three terms are used to define the moneyness of an option. 1. In the money option. 2. Out of the money option. 3. At the money option. In the money option, an option is said to be in the money if on exercising the option, it would produce a cash inflow for the buyer. Thus, call options are in the money when the value of spot price of the underlying exceeds the strike price. On the other hand, put options are in the money when the spot price of the underlying is lower than the strike price. In the money option, moneyness of an option should not be confused with the profit and loss arising from holding an option contract. It should be noted that while moneyness of an option does not depend on the premium paid, profit/loss do. Thus a holder of an in-the-money option need not always make profit, as the profitability also depends on the premium paid. Out of the money option. An out-of-the-money option is an opposite of an in-the-money option. An option holder will not exercise the option when it is out of the money. A call option is out of the money when its strike price is greater than the spot price of the underlying, and a put option is out of the money when the spot price of the underlying is greater than the option's strike price. At the money option. An at the money option is one in which the spot price of the underlying is equal to the strike price. It is at the stage where, with any movement in the spot price of the underlying, the option will either become in the money or out of the money. Participants in a derivative market. All the investor categories use the derivatives market as a part of risk management, investment strategy or speculation. Based on the applications that derivatives are put to, these investors can be broadly classified into three groups: hedgers, speculators, and arbitrageurs. Participants in a derivative market. Hedgers. These investors have a position, that is, have bought stocks, in the underlying market but are worried about a potential loss arising out of a change in the asset price in the future. Hedgers participate in the derivatives market to lock the prices at which they will be able to transact in the future. They try to avoid price risk through holding a position in the derivatives market. Hedging in futures market can be done through two positions, viz., short hedge and long hedge. Short hedge. This involves taking a short position in the futures market. Short hedge position is taken by someone who already owns the underlying asset or is expecting a future receipt of the underlying asset. Long hedge. This involves holding a long position in the futures market. A long position holder agrees to buy the underlying asset at the expiry date by paying the agreed futures forward price. This strategy is used by those who will need to acquire the underlying asset in the future. Speculators. A speculator is one who bets on the derivatives market based on his views on the potential movement of the underlying stock price. Speculators take large, calculated risks as they trade based on anticipated future price movements. They hope to make quick, large gains, but may not always be successful. They normally have shorter holding time for their positions as compared to hedgers. If the price of the underlying moves as per their expectation, they can make large profits. However, if the price moves in the opposite direction of their assessment, the losses can also be enormous. Arbitrageurs. Arbitrageurs attempt to profit from pricing inefficiencies in the market by making simultaneous trades that offset each other and capture a risk-free profit. An arbitrageur may also seek to make profit in case there is price discrepancy between the stock price in the cash and the derivatives markets. Uses of derivatives. Risk management. The most important purpose of the derivatives market is risk management. Risk management for an investor comprises of the following three processes. 1. Identifying the desired level of risk that the investor is willing to take on his investments. 2. Identifying and measuring the actual level of risk that the investor is carrying, and 3. Making arrangements which may include trading, buying, selling, of derivatives contracts that allow him to match the actual and desired levels of risk. Market efficiency. Efficient markets are fair and competitive and do not allow an investor to make risk-free profits. Derivatives assist in improving the efficiency of the markets, by providing a self-correcting mechanism. Arbitrageurs are one section of market participants who trade whenever there is an opportunity to make risk-free profits till the opportunity ceases to exist. Risk-free profits are not easy to make in more efficient markets. When trading occurs, there is a possibility that some amount of mispricing might occur in the markets. Price discovery. They provide valuable information about the prices and expected price fluctuations of the underlying assets in two ways. First, many of these assets are traded in markets in different geographical locations. Because of this, assets may be traded at different prices in different markets. In derivatives markets, the price of the contract often serves as a proxy for the price of the underlying asset. Second, the prices of the futures contracts serve as prices that can be used to get a sense of the market expectation of future prices. Thank you. Revise and get ready for the next.